So welcome and thanks for attending the panel. So my name is Sophie Monas and I'm a professor of finance at Toulouse School of Economics and the scientific director of TSC Sustainable Finance Center. And I'm very pleased today to moderate this panel in which we will have Barbara Buckner, hopefully, from Climate Policy Initiative, Geoffrey Hill from Columbia Business School, Marie Brière from Amundi and University Paris-Dauphine, and Stefano Batista from the University of Zurich. So today we will discuss and debate about creating incentives for sustainable finance. So the first question one could ask is, why are such incentives needed? Well, we are well aware that we need to achieve a path towards more sustainable economic growth in particular, and there is a huge effort in the reduction of carbon emission that is required to fight against climate change. The good news is that in the last decade, lots of things have been accomplished in order to fight against this climate change. The first thing that has been accomplished is that really there is an increase in awareness. So let's take the example of Europe, for instance. The European Commission has adopted an action plan aiming at cutting CO2 emissions by 55% by 2030. And the number of countries that have pledged to achieve this net zero emission has grown rapidly over the last year and now covers more than 70% of the global carbon emissions. Many companies also have made the same pledge. The second good news is that somehow technology is helping us. On the one hand, there has been a huge decrease in the price of renewable energies. If you take the example, for instance, of photovoltaic, it has the cost of production has decreased by 90% since 2010. For the wind, it has decreased by 50%. This is a huge improvement that helps a lot in our hedge in the race to zero. And on the other hand, we contemplate growing innovations opportunities. So for instance, advanced batteries, hydrogen electrolyzers, direct air capture and storage. Consequently, if you look at the report of the International Energy Agency, the last report, they expect by 2030 an average energy intensity improvement of 4% per year, okay, which is rather good news. Unfortunately, there are bad news, and the project of the report from the Intergovernmental Panel of Climate Change that was issued today is actually a very painful reminder that we are very far from the finish line. In particular, even if everything is successfully fulfilled, there will still have devastating consequences on poverty, starvation, extreme weather conditions, and so on. So obviously, reaching the objective is going to require lots of efforts from the citizens in terms of transport, heating, cooking, and whatnot. But beyond what the citizens can do, as economists, we know that whenever there is a market failure or an externality, we need to find a way for the economic agents to internalize these externalities. So the efficient carbon pricing scheme seems really the first best solution for CO2 emissions. However, for various reasons, including regulation failures, there is room for more, and there is room for participation of the private sector, which is why, as mentioned in the topic of the panel today, we need to create incentives for sustainable finance. So to introduce the debate, the rules of the debate, we'll have an introduction from our panelists that will explain a bit what is the current situation and what are the challenges that are raised by this fight against climate change. And hopefully they will turn to potential solutions, recommendations, suggestions in order to end on a more positive. There is a Q&A, so feel free to ask questions that I will ask at the end of the general introduction, and these are the rules. So I'm not sure whether Barbara is here. So Barbara could not join us first. So I'm going to give the floor to Geoffrey. So just so Geoffrey, actually, it's kind of easy to introduce him because, as you know, he's the past president of your association organizing the conference. Geoffrey is a professor of economics at Columbia Business School, member of the National Academy of Science, fellow of the Econometric Society. I'm going to stop here because it's very difficult to list all his achievements. And Geoffrey is also very involved with environmental organizations. So, Geoffrey, the floor is yours.
Well, thanks, Sophie. It's that very kind introduction. And also thank you for setting up the context so clearly. Let me start off with some fairly general remarks about the role of capital markets and then zero in and perhaps pick up some of the points that Sophie was making in a bit more detail. And there's classically, and this has nothing to do with the environmental field, just in general, there are two major roles for capital markets. One is to sort of allocate its funds from savers to investors. And the second is to provide a mechanism for the mitigation of risks. And both of these roles are really going to be extremely important in the energy transition, which has to accompany the solution of the climate problem. During this energy transition, we're going to need to channel somewhere of the order of $10 trillion, maybe more than this, from institutional investors to investments in new energy systems around the world. And a lot of this is going to be investment in developing countries, because a lot of this investment has to occur in developing countries. And obviously, many developing countries don't have significant sources of savings. So a lot of this investment, the channeling of investment, is going to have to occur across borders. We're going to be seeing quite unprecedented cross-border flows of capital if we're going to support the energy transition adequately. This is going to be going from institutions like pension funds and so on in rich countries to energy systems in poorer countries. Now, this is challenging in its own right. Obviously, we're simply not used to seeing investment on this kind of scale. In addition, there are some specific risks associated with this. Obviously, there are exchange rate risks. Investors are used to coping with exchange rate risks between, let's say, pounds and dollars, or euros and dollars, or yen and dollars, or even renminbi and dollars these days. But how about Thai baht or some of the currencies in Africa? There's going to be significant exchange rate risk whenever there's cross-border investment. Those exchange rate risks can be borne by the investors, or they can be borne by the local population, but they have to be borne by somebody. So the question is how to classify these risks and how to manage these risks. There are political risks. As you're investing in markets you know very little about. There are sort of idiosyncratic political risks specific to each country. Maybe there's in some countries a risk of nationalization. In other countries there's a risk of a significant change in the regulatory regime. In general, the production of energy is a regulated activity in most countries. Regulators put caps on the returns that can be earned, or put caps on the local prices that can be charged. And these caps can change over time. And there's a risk of those changing in a way which can damage the return and make it impossible to achieve the expected return. So there's a whole range of risks that are going to occur in the context of these very large cross-border flows into regulated activities in developing countries. And so we'll need to think very hard about how we mitigate these risks, and I hope that's something we can come back to talk about later in the session. Let me also mention a specific type of risk which I think is perhaps a little bit unique to this field of energy transition. Sophie mentioned in her introduction the sort of dramatic changes in technology that have occurred in the last, well, as recently as the last 5 or 10 years. She mentioned that the cost of solar power has come down by, I think you said 90%, which is quite remarkable actually. And there's been similar, not quite such big, but similar drops in the cost of wind power. Now there's a PhD student of mine, a guy called Raimundo Attal, has done some very interesting calculations about the impact of this in terms of obsolescence. If a wind turbine which was built 15 years ago, 10 years ago even, just 10 years ago, is today obsolete because of the huge increase in the productivity of wind turbines that's occurred since then. Wind turbine sites are actually quite scarce, and it's difficult to find a really good site for a wind turbine. You need a location ideally where the wind speed is high and the wind is stable. And you also need to be near to the grid, so you don't have to spend a huge amount of money connecting your wind farm to the grid. So there's relatively few really top-rate wind sites. And unfortunately, a lot of the top wind sites were adopted and were built on very early on. They were built on as much as 10 years back, and the productivity of wind turbines is actually much, much less than it is today. Productivity of wind turbines has increased enormously in that period. Raimondo calculated that over some periods of 3 or 4 years, productivity of wind turbines, the output of wind turbines, has increased by 20 to 30%, which means that if you built a turbine on a particular site in, let's say, 2012, you've got one output. If you just waited till 2015 or 2016, you might have got 30 to 40% more output. And over the life of the turbine, that's obviously a huge improvement. And that's a waste from a private perspective. It's also a waste from a social perspective. So that's the kind of risk that obsolescence, that rapid technical change generates. Raimondo et al. Looked specifically at wind turbines, but I'm sure something similar is happening with solar power as well. The productivity of solar installations has also increased dramatically in this period of time, and is likely to continue increasing. There's a lot of new solar technologies coming, which will probably be implemented in the next 5 to 10 years, and they again will make the current solar installations look obsolete. So there's a real risk there. I don't know how we can use capital markets to manage obsolescence risks. It's not something we've really thought about very much before, but it's something I hope we can come back to in the discussion later on. Okay, Sophie, let me hand this back to you. I think I'll use my piece of time for the introductory remarks.
Thank you very much, Geoffrey. That was a very nice introduction. So we are very happy to have now Barbara with us, finally. So Barbara is Global Managing Director of the Climate Policy Initiative. So maybe you will talk a bit more about what CPI is. It's an advisory organization that aims at helping governments, businesses, and financial institutions drive economic growth while addressing climate change. I'm very honored to have you on the panel because you have been named one of the 20 most influential women in climate change and one of the 100 most influential people in climate policy. So it's a great honor to have you. You direct the Global Innovation Lab for the Climate Center and its sisters program in Brazil and India. So I'm going to share your screen and the floor is yours.
Fantastic. Thank you so much, Sophie. And clearly not one of the most famous people in IT yet. That's on my, the bucket list going forward. But thanks so much, Sophie. It's a true pleasure being here today with you and with this esteemed panel here. And again, I think what we had wanted, if everything had worked a little bit better, is like to have me a little bit set the stage with some context of where we are today in terms of climate finance. So, again, as Sophie mentioned, I'm Barbara Buchner. I'm the Global Managing Director of Climate Policy Initiative. In addition to what Sophie already said, what we really are most known for is our analysis in understanding where we are today in terms of global climate finance. So if you could get to the second slide, please. And our flagship work in this area is the Global Landscape of Climate Finance, which is the most comprehensive assessment of annual investment to address climate change, which is available. So before we talk about where we need to go and follow up from some of Geoff's ideas really on what needs to happen, let's just quickly take a look of where we stand right now. And at CPI, we have been tracking global public and private investments into climate action for now a decade. And the latest full edition of our report found that annual track climate finance in 2017 and 2018 crossed the $500 billion mark for the first time and steadily increased to approximately $600 billion. And this trend obviously is good news. It does reflect steady increases in financing across nearly all types of investors. But let's make it a little bit more complicated on the next slide, please, where you can see our well-known spaghetti diagram, as we call it, as it was born when we had our first office in Venice. And this provides you really with a snapshot of all the data we gather. We capture available data on primary financing, supporting greenhouse gas emission reductions and climate resiliency and adaptation activities. And our landscape report really consolidates data from a wide range of primary and secondary sources. So what we do here, and you can see it on this graph, that the landscape really follows the financial flows along their life cycle, from the original source of financing, public and private, which is here on the left-hand side of this graph, through the financial intermediaries, their deployment in the form of financial instruments, and the recipients of finance, to how finance is ultimately used on the ground. So to combine data from various sources, we have adopted an operational definition of climate finance and a standardized accounting methodology in order to ensure that data are comparable and consistent and that overlaps are avoided to the fullest extent possible. So again, this diagram here is, of course, very small on the screen, so I won't expect you to look at the details here. It's all available on our website, but I would like to leave you with a few. Again, and I said it a little bit before, public and private commitments continue to rise across categories. In our latest landscape, we tracked an average of 504 billion annual climate finance in 2017 and 18, which is almost a 25% increase from the 2015 average. We're going to update later this year, so stay tuned for that one. Just behind climate finance, the private sector provides the bulk of finance, but the public sector really remains the engine behind. So it remains the engine behind because of these among public sources of investment, there's the development finance institutions that continue to channel the majority of those investments, and the sources of public finance predominantly go to renewable energy and transport, and the public side is on the upper side. But since many years now, private storage of 50%, and what we see is that corporates now make up most of that. But in recent years, commercial financial institutions and institutional investors, their levels of climate finance, primarily maturing renewable energy market, being perceived to be less risky. And I think another notable trend that we've seen on our latest adoption of lots of electric is that the vast majority of finance, which is about 93%, that we can track irrigation activities, like but adaptation finance, or the money that really is going to activities like drought resistance or seawalls or water systems or resilience building, that stands only at 30%. It has increased over the last years, but while the low proportion of adaptation is partly due to tracking and methodological gaps, it clearly also reflects an overall disparity investment. So I really want to make sure that we have this overarching insight that we need to really go beyond renewable energy in order to address the climate challenge. And then the third point I wanted to leave you with is just geographically, where does the money end up? What you see is that the majority of climate finance and countries, which is similar shares in previous. The point I want to leave you with here on geographies is that the majority of finance was raised and spent in the same country. It's about 3/4 of total climate finance flows were raised. It also highlights the importance of domestic investment, because domestic investment dominates. It is vital to get national policies right. So just in a nutshell, is positive, but that we are falling far short of the needs, particularly outside of the energy sector. And so just on the next slide, I wanted to give you a little bit the dimension of where we stand and what is needed in terms of really investment in order to getting us on a zero carbon sustainable pathway. Again, the $6 billion that we can track at the moment is far below where we need to be right now. What you see on this slide just shows you the investment gap for global energy transition, and it's a at that 6 to 3.8 trillion need for supply side investment identified by the IPCC. So when we consider the total investment needs across all sectors to address adaptation, the investment need increases significantly. And just as an example here, for infrastructure, the OECD recently estimated that we need about 6.3 trillion of investment each year up to 20. The Paris Agreement. On the next slide, I think that the point I also want to make sure that I leave you with is we know that obviously increasing sustainable finance is not enough. On the energy sector, as an example, no major country or region is currently decarbonizing its power sector at the required pace to meet Paris goals. We obviously all have heard positive stories over the recent years of how investment in renewable energy generation now exceeds generation. But if you add the really infrastructure investment, we get a very different picture. And so if you can just click one more time for to see the oh, sorry, no, go back one more time, then I maybe you can't see because of the light. But what I wanted to show with this graph here is that the total investments in fossil fuel generation and infrastructure remains robust and is actually as many multiples of renewable energy investment. And so no major investor category is fully aligned with Paris aligned emission intensity targets for the power sector, including development finance institutions. And while obviously continued financing for this types of activities would really increase the risk of missing not only abatement targets, it also magnifies the financial transition risks related to stranded assets and contrasts starkly with the goals. And I know that our colleague Stefano is going to talk more about that one. So again, I think just like as we are all transforming the energy system, investment must urgently shift away from high carbon assets and towards green alternatives, also in land use, transport, water, and industry. But again, the last point, and then I promise to hand back to you, Sophie, is the positive one on the next slide. Again, we should not let those numbers intimidate us. There are hundreds of trillions of dollars in global equity and debt markets alone, and there's significant opportunities. This is like a study from a few years ago that shows that pursuing low carbon sustainable growth path could result in global GDP, economic and social benefits exceeding $26 trillion by 2030. Whereas we of course know that business as usual, which will accelerate global warming, will likely cause significant drops in global GDP and significant increases in social disruption and harm, such as reduced life expectancy, but also mass migration, deeper income inequality, and increased unrest. So I'll just leave it here. But again, I think the overarching point, we are, increasing investments. But if we really want to get on a pathway that allows us to address climate change and put this work on a more sustainable pathway, we need to seriously shift investments from high carbon into low carbon, and we need to go beyond the energy sector to really cover all sectors of our economies and really shift our economies. And with that, let me move a hand back to you, Sophie. Sorry for taking a little longer.
Thank you very much. So now we understand that there is a huge investment gap, but yet we also see that the private sector is actually willing to participate. There are risks, as Geoffrey told us. So the question now is, what are the challenges for fund managers and businesses? What are the specific challenges that they may face? And to address this point, I'm going to leave the floor to Marie Brière. So Marie is actually the head of Investor Research Center at Amundi. So Amundi is a big asset management company belonging to Crédit Agricole and Société Générale. Marie is also an affiliated professor of finance at Paris Dauphine University and an associate researcher at the Center Émile Bernheim at Solvay Business School in Brussels. So Marie is a kind of double spy here. She's actually bridging the gap between the academic world and the industry, both enlightening the asset managers and the pension funds and so on with what the latest development in research, and at the same time trying to shift a bit the research question that she addressed based on what is really crucial for the asset management industry. So that being said, Marie, the floor is yours.
Thank you very much, Sophie, for these very kind words. And I have to say that I pretty much agree with what has been said before, and I'm happy to follow Barbara on what she addressed and the needs of the private sector and financial markets in funding an efficient green transition. So I would definitively agree on that. and also withdraw from the risk. And I think it's important that we come back on this discussion. So I think today we have a better understanding of the scope of financial assets that are exposed to climate risk. And I have to thank Stefano for that. I think Stefano Batista's work on these questions has been quite influential. The work on climate stress tests, and then also the work by the European Commission to impose a green taxonomy, all that types of efforts have been very important in having this better understanding of what we'll call the assessment of climate risk and the scope of financial assets that are exposed. But it's not sufficient. And to achieve an efficient green transition, we also need that the finance industry converges in the use of carbon price trajectories that are compatible with climate objectives. And here we see a lot of progress in this direction, but in my opinion, as you stressed, Sophie, there are still important challenges. So I would like to highlight what are practical challenges that the practitioners face when they're willing to do that. And there are a lot of initiatives in that direction. So I first would like to stress the progress that have been made and highlight a few of these new efforts that have been made in that direction. So first of all, fund managers are more and more evaluating firms based on carbon price trajectories. So that's, I think, a very notable point to make. So for example, they use the carbon price scenarios from integrated assessment models coming from IPCC. There is also an increased use of temperature ratings of companies, but also portfolio indices. So the Science-Based Target Initiative launched a project to convert firms' target into temperature ratings. And the idea was to translate the company's greenhouse gas absolute emissions reduction target into an ambition of alignment to a certain degree, let's say 1.5 or 2 degree world. And this is again something which is more and more used by asset managers to assess the global warming of their portfolio. And last but not least, there is also an increased use of internal carbon prices by firms themselves. So some firms that we invest in our portfolio, they provide also an internal carbon price. But unfortunately, there are some difficulties. One first difficulty is the fact that there is considerable leeway in how we can define carbon trajectories. So there is a large dispersion in the social cost of carbon estimation, depending on the method that you're using. And then also another issue is that the social cost of carbon differs a lot from the effective carbon price, which is defined by countries. So if you look at carbon taxes, for example. And then the operational question, for example, is should the pricing of the firm be made by using the current effective price incurred by the firm, which is reflecting its current cost, or should it be done with a theoretical social cost of carbon, but which is subject to a very large uncertainty? Or should we consider a mix of the two? And some players are doing that, like considering a trajectory, transitioning from the current effective price to a social cost of carbon that would be assessed from a theoretical model. And here you see there is no unified framework in the industry, so everyone has his own assessment methodology, and that of course leads to a wide dispersion in the evaluation of firms. So here, working on maybe more unified methodologies would be something very important. If you look at firms, because I was talking about asset managers, how they deal with this problem when they need to assess firms. But if you look at the firms themselves and you look at their carbon prices, the one that they provide, for example, through the Carbon Disclosure Project, there is also a very large heterogeneity in the carbon prices. So that can lead potentially to large inefficiencies. And a second problem is related to the effective carbon prices, because they differ a lot between countries, and that can lead to carbon leakages. So that's also an issue that we have to face. A third problem I would like to highlight, or difficulty, is how to achieve firms' commitment. And I would be very happy to have your view and discuss this point, how to make sure that they will respect their stated ambitions. Because right now they are disclosing a lot of ambitious targets, but there is no sanction mechanism if they don't realize what they committed to do. So of course, then we always say, okay, there is a reputation risk, and also they may be temporarily excluded from socially responsible indices or portfolio that impose a threshold on this kind of objectives. But is it sufficient? I'm not completely sure about that. So thinking about effective sanction mechanism, it's not a very kind word, but at least incentivizing firms to respect their ambition, I think is something important. And then I have a last question I would like to discuss because it relates to Geoff's points about the risk in transitioning and the question of technological obsolescence and the path at which we should fund the transition. And I think it also relates to the current work that Stefano is doing. So I think it's an important point. So as Geoff rightly pointed, I think it's not always clear that there is an adequate allocation of capital, both through time and across firms. And I think one reason for that, which is another underlooked point, I think, is that financial markets are prone to sentiment. It has been already demonstrated during the tech bubble, for example, that financial market players are not always rational. And a big question right now about green finance is there also green sentiment, and how much does that impact valuation, firms' assessment, and potentially firms' behavior? So we've been working on that question with Stefano Ramelli, who is a researcher at the University of Zurich, to try to identify a measure of green sentiment. Green sentiment meaning demand for green assets that is not driven by fundamentals, right? So the way we did that, and could be challenged, but that's maybe a preliminary step, was to measure the arbitrage activity in the ETF market. So the redemption or creation of shares in the ETF primary market that is reflecting non-fundamental information about the firm, meaning not incorporated in the underlying securities. And that is supposed to reflect the change over time in investor state for green assets. So green sentiment is this irrational, if you wish, taste for green assets that is not explained by climate fundamentals. What we found is that this measure of green sentiment has a very large impact on firm prices. So typically we find that both green sentiment and climate fundamental information have an impact on stock returns. And green sentiment explain an outperformance of green firms of around 60 basis points over 6 months. And we estimated that over the last 10 years, with an impact which is of the same order of magnitude than the climate fundamentals. So then the question is what the impact potentially of green sentiment. Firms benefit from that because it means that their cost of capital will be lower if they benefit from this green sentiment coming from financial market. And that can potentially distort the efficient allocation of capital through time, but also across firms, right? Because some firms may be more prone to green sentiment than others. So it has real effects. And in our paper, we show, for example, that green sentiment has an impact on firms' investment, cash holding. And then the question is it good or bad? And maybe Stefano might argue later on that it can help funding at a quicker pace, the green transition. So maybe that the good thing and the good consequence of this green sentiment. But you could also think that it might lead to anomalies in financial markets. And so we should probably raise this question. And also something that we should probably debate is, do firms benefiting from green sentiment, do they use efficiently the proceeds? We find that they invest more, but we are not sure that they invest more in the green energy transition, right? So that's something that should be tested. We find, for example, that there is not so much impact on R&D expenses, but how much does this sentiment leads to a green energy transition is still an open question. So with that, I would pass the floor to you, Sophie, and probably Stefano.
Thank you, Marie. Indeed, we need to keep some time for the debate. So our next speaker is Stefano Batista, who is a professor in sustainable finance and networks at the University of Zurich, but he is also a professor at the University of Venice and the IPCC lead author in the chapter of finance. What is very nice about Stefano Stefano, I told you earlier that Marie was kind of a double agent. Stefano is actually also bridging a gap, the gap between different disciplines, and showing that, you know, combining different disciplines is going to help us in understanding really the path forward in the different scenarios and the different trajectories Marie mentioned about carbon prices and expectations. So that being said, Stefano, the floor is yours.
Thank you very much for the to see my screen. Okay, excellent. And I promise that I'll keep the time. So I'm really glad for the invitation to this panel, and I'll try to contribute to the question about how to create incentives for sustainable finance. What is the take-home message that I would like to contribute for this panel? And when we ask what incentives there are for sustainable finance, one of the main focus that are coming from environmental economics is in general on the optimal pricing of externalities. And here I would like to point out to a sort of maybe a blind spot, not for everyone, but for some, which is about the role of climate-related financial risk and the endogeneity of that. And what I mean by that is that essentially, in order to define incentives for investments, well, risk is a clear determinant of investments, and risk is determined based on scenarios, but these scenarios don't take into account the fact that the actors are looking at the scenarios themselves. I will elaborate a bit more on that. Now, in particular, the climate mitigation scenarios that have become already a reference for investors are the NGFS, Network for Green the Financial System. It's a platform of central bankers and investors, and the scenarios are taken, essentially selected from the IPCC mitigation scenarios. So there is, what we argue here is that there is a missing feedback loop, and putting it back is critical in order to make sure that the transition is well understood. And I will, as a result, show how there is a new way of looking at the role of policy credibility for that. So visually speaking, these are the steps. On the side, we see climate scenarios. These are, for instance, the trajectories of emissions, and in the current policy scenarios that essentially lead us to about 3 degrees by the end of the century, as opposed to the 2-degree scenarios or 1.5-degree scenarios. They translate, however, in economic trajectories in terms of economic production output levels, and they differ quite a lot, as you see on the bar. I'll elaborate on that, but here we're contrasting two different technology, low carbon and high carbon. And as a result, investors are, first of all, disclosing. They're encouraged by financial supervisors to do so, but also by the social pressure to say, and reputational cost of not doing so. Not only they disclose what they have in their portfolio, but based on the scenarios, they are currently already adjusting key metrics of risk, such as climate value at risk, the value at risk, which becomes a climate value at risk, and expected shortfall. Now, what is missing is that as a result of those adjustments, new investments and capital allocation presumably would occur, but nothing guarantees that this reallocation and this new level of investments, and Barbara was showing us the beautiful representation analysis of the flows at a macro level, and nothing guarantees, unfortunately, that they are consistent with the scenarios that were driving them in the first place. Let me elaborate a bit more. climate scenarios are not predictions. We probably all know that. They are more of a description of plausible trajectories in the future, constrained by physics and technology. And they're many times generated with so-called process-based integrated assessment models, which are quite different from the more aggregated ones, such as the DICE. There are known limitations, but essentially the issue of the market expectation was not really previously analyzed in detail. And what I'm presenting here is building on a previous work on climate stress testing, which was the first work that actually showed how to translate these integrated assessment model trajectories into financial risk. There's a number of applications, in particular on supervisory data, and now very ongoing, in particular with the European Central Bank, with some colleagues. So don't get me wrong, the NGFS are representing really a major step to provide financial actors with information about how to assess climate-related risk. However, we have to be aware of this missing feedback loop. And in particular, financial supervisors have been choosing 4 high-level scenarios, which are grouped depending on the level of physical risk on the horizontal axis and transition risk on the vertical axis. And in particular, there is most concern is about the so-called disorderly high-level scenarios, where the transition would happen somehow sudden and not fully anticipated way. That means that market participants wouldn't have the ability to fully anticipate or fully hedge the shocks. They translate into, as I said before, quite different trajectories for output. And I'll say in a moment why this is important. Consider a utility company that wants to shift its power plants from high carbon to low carbon. And when we look at the scenarios, the output that is expected under various scenarios from electricity based on wind are quite different, whether you look at the current policy, which shows some growth, but not as much growth as it would be required under an immediate 1.5 scenario. And if the production is based on coal, and these pictures refer to the region of China in particular, where differences are even more pronounced, under current policy, there is a peak in about 2035, while under 1.5, the peak is should have already been passed. Now, that translates into the following. The financial system, which is usually considered to play mostly an enabling role by providing the needs, providing the funding that are needed without frictions essentially in the models, could in fact play a hampering role. And that happens if in particular the climate policies are perceived as not sufficiently credible. And that would imply that the desire of the firm to adjust its technology mix would lead to, in fact, the bank asking for a higher interest rate. So this means that in particular, a risk scenario, which a transition scenario that is, however, associated in the mind, if you want, of the investors to a too low risk level, could actually make this scenario unfeasible. And the way forward for that is to, how to address this, is to combine the traditional framework for integrated assessment models with a complementary framework, which is climate financial risk models, where essentially the trajectories are used to compute metrics of risk, and in particular then as a result an interest rate, which is going to be sector specific, technology specific, high carbon versus high carbon. And this is fed back into the integrated assessment models and providing an additional term, and this is over time, so it's a dynamic. And then by iterating this process several times, you get new scenarios. And an example of new scenarios is shown here, where we analyze on the one hand the type of the policy, immediate or delayed. This is one of the fundamental dimensions in the IPCC scenarios. And on the other hand, whether the role of the financial system is enabling or hampering along what I just said. And the result is that you get new trajectories where each financial system is playing along, so it's believing in the policy. The trajectory, for instance, for the low carbon starts earlier because financial actors are actually anticipating the introduction of the policy, therefore anticipating the risk and adjusting the interest rate they're charging to the different technology. And as opposed to the situation in which the financial system is not believing into the policy, and then even if the policy is introduced early on, essentially there is a delay in the update of these interest rates and in their reallocation, which can then lead to sudden adjustments and therefore higher costs also at a social level. And maybe I stop here, but just want to anticipate that there are a number of policy implications that both in terms of fiscal policies and financial policies, but maybe this can be left for further points in the discussion.
Thank you very much, Stefano. So you started kind of leading the way towards, well, what can we do now, given the huge challenges that we have all mentioned. So what I'm going to do is that I'm going to leave the floor to Barbara. Barbara, if you could, in a couple of minutes, hopefully, start discussing a bit what you are doing. I can share your slides.
I don't need slides. Let's do without slides now. I think again, I think it's been really great to hear the other panelists, and I think I'm trying actually to bring some of what I heard from them also into what we feel are some of the areas of how you can help close the investment gap and what are solutions. So for me, number one is policies lead the way. I think we continue to see that. We're seeing very clearly that good policies are key to transforming the financial sector and creating also the platform on which sustainable investment can thrive. And I think, green fiscal policies like pricing carbon, like reforming fossil fuel subsidies, but also procurement policies or green budgeting are important elements in the government's response toolkit. And I think a little bit what Stefano just said, like I'd love to hear also his thoughts on some of the policies. But I think the second under the policies is I think we do need to start with the fundamentals, and it comes back to also what we've heard a little bit from Marie before. I think governments need to adopt taxonomies and mandate disclosure. And I think it's not easy, but we really need to ensure that there is a better standardization, harmonization. I think the European Union and several member states are leading the way, and I expect there will be more later in this year, but I really think we need to have more of the mandates. And I think the third area under the government policies is really, I think policy can really shift towards more strategic use of public finance and mobilization of private capital to invest in mitigation and adaptation. And as you saw from my earlier slide, I think public finance is really important, but it cannot scale to reach the trillions that we need, but it can be used more effectively to address the harder sectors and seed innovation and de-risk earlier stages of investment that would help catalyze multiples more of private finance. Two areas, but I won't go into detail. We hopefully come to that in the discussion. Is for me, the second part is really innovation. And when I talk about innovation, it's not just about technology innovation. The financial sector really needs to take an innovative, develop new products, new business models, instruments and services that can catalyze capital towards sustainable investment. Again, I think we've already heard several ideas on this panel, and I'd love to share also a little bit what we do in this context, maybe in the conversation. And then the third topic that I'd like to mention is just capacity building. I think obviously increasing the flow of capital is crucial, but it cannot occur without building capacity at all levels. And that's for the recipients of funds, that's for investors, it's for again, just I think to fill the gap with solutions, we need collaboration and really partnerships across the financial system, public, private, academic, and really transparency. And I think we heard a lot already about methodologies and good data, and I think that's certainly key.
So Geoffrey, what are your recommendations? And I know that you are already going to address Barbara's second point on the innovations. You are still, yes.
You're right, it's a classic mistake, sorry about that. Let me just say how much I agree with some of the points that Stefano was making. I think they're very important. I think this point about the endogeneity, the uncertainty is one which hasn't really been emphasized enough. It might be interesting to note actually, Stefano, that there's quite a big climate literature by climate scientists which tries to break down the sources of uncertainty about the climate system, 30, 40, 50 years ahead. And when you go sort of 30 to 40 years ahead, they all say that by far and away the largest source of uncertainty is what we will ourselves do, what policies we will implement. It's not uncertainty about the models. It's not uncertainty about the parameters of models. It's uncertainty about the policy responses, which is the endogenous uncertainty that you're talking about. So it really is very important. And I think that emphasizing that feedback from the conclusions of scenarios, implications of scenarios to policies is crucial. So great point there. Second point I'd like to make, Sophie, is just about a carbon tax. A lot of people have mentioned the importance of having a carbon tax and a carbon price, and obviously I totally agree with that. The problem is that in practical terms, it seems to be a very difficult thing to achieve. I mean, there's no prospect of getting a carbon tax here in the United States anywhere in the near future. France is obviously, as you people know very well, has had major problems with carbon taxes, and just about many countries in the world have had serious problems with carbon taxes. And I think the problem is quite a deep one here. I mean, the Wolfram Schlenker and I recently wrote a paper about carbon taxation, where we used a kind of a dynamic approach, hoteling type approach to estimating the carbon tax which would be needed to really implement an energy transition efficiently. We came to the conclusion that the carbon tax would have been very much higher than many people have anticipated. We were estimating that a relatively low carbon tax is sufficient to drive out coal and gas from the marketplace. But oil is much more challenging because there are so few substitutes for oil, and the elasticity of demand for oil is really very, very low. In order to push oil out of the market successfully, you have to have a carbon price which runs to several $100s per ton of CO2. And a carbon price of several $100s per ton of CO2 would have a big impact on retail gasoline prices, a very big impact indeed. And I think that makes it politically extremely challenging. So while I think it would be great to have a carbon price, and particularly a uniform one around the world, I do think the politics of carbon taxes are very challenging. And I think that that's a reason why we need to think about subsidies for renewable energy as opposed to prices on non-renewable energy. And it's the other side of the coin, obviously. Anyway, that's just some comments that were prompted by the other people's remarks. Let me get back to the points I was going to make. And I said earlier on that there's a number of serious risks associated with cross-border investment, particularly cross-border investment in developing countries. I mentioned that we need, in order to fund the energy transition, we need to have huge investments probably from Western countries into a range of developing countries in energy-related infrastructure. And as I said then, that's challenging because energy is a regulated field. You can't charge any price you want for energy. You can't necessarily charge a profit maximizing price for energy. And there have already been several occasions when Western investors in energy systems in developing countries have found that the prices they try to charge are politically unacceptable. And they run into some serious political problems because of that. So we need to think of some way of trying to mitigate these risks. And that's not easy. My own sense is that the most promising developments there are these sort of so-called blended funds, where you have a mixture of public and private money. You have some public money here. I mean money from international agencies, maybe money from the World Bank, money from multilateral development agencies, and so on. And maybe sort of funds which are 15–20% public money, and then the balance is private money. And the point about the public money is that it can take certain types of risks, take priority on certain types of risks. So, for example, political risks. Maybe we have an agreement that certain types of risks are classified as political risks, and losses from these political risks are taken primarily by public money. And private money takes risks which are perhaps more standard commercial risks. So we need to somehow factor out the risks into political and non-political risks there. And then leave the Western investors to take the kinds of risk which are commercial risk, which they're used to. but have a different mechanism for taking some of the more politicized risks. Now, I mean, there's pluses and minuses to doing this. I can see that this could be politically contentious. But I think that if we want to get the sort of flows on the scale that Barbara was talking about, and I think the scale is absolutely right, we're going to need trillions and trillions of dollars of cross-border investment here. We're going to get that kind of flow. It's going to come from like pension funds, insurance funds, and so on in the US and Western Europe. Then we have to do something quite substantial about mitigating some of these risks.
Thank you very much, Geoffrey. So, Marie, you are going to suggest an alternative solution.
No, I would agree with what was said before, but maybe an additional idea, maybe a little bit orthogonal to with what has been said before. I think one key question is to put the right incentives, as we discussed, and also incentivize categories of investors that could be also key in that process. And I think that retail investors were maybe the neglect.
So we have lost Marie.
Here, right?
You're back.
You're back. Okay. Yeah, so I was just mentioning that retail investors, they played a minor role in that process so far. In 2013, for example, they represented only 3% of ESG investment, but they're playing a bigger and bigger role. And today they represent 30% of ESG investment. So they can really have a growing importance. And I think that we should also think about designing right incentives here in order to channel these flows of investments towards green finance. And they're willing to do so. For example, we studied what happened in France in employee savings plans. Amundi is a very large manager of these employee savings plans, one of the biggest in France. It's a bit like the 401k in the US.
You are muted.
Okay.
Yeah, just one sentence ago.
Okay, great. I didn't do anything. So, okay. So I was just saying that it's a bit like in the 401k, people are offered a menu of funds. And we looked at what happened when they're offered a sustainable fund in the a sustainable equity fund in the fund offering. And we found that it had a massive impact on their asset allocation. And typically they changed their equity exposure when they were offered a sustainable fund, a special kind, very popular in France, which is called a solidarity fund. And in a very substantial way, 50% in relative term, in their increase in equity exposure. So there is a massive appetite in, I would say, well-designed, well-communicated ESG funds, green funds, that is probably underlooked and that can have a very important impact on this funding process. And this experience that I'm mentioning in France that we measured on the employee savings plan is something that is also very important in the Netherlands, where there were experiments where researchers asked directly pension participants if they were willing to invest in ESG funds, if they were willing to incur a lower return for that, and people were massively answering yes to these questions. So there is this appetite that could be quite important to fulfill. And maybe another unrelated point that was not mentioned or not completely addressed before, because we mentioned the importance, and Geoff mentioned that the importance of addressing risk, political risk, foreign currency risk, etc. But also I think we lack instruments to manage climate risk, and we could probably ask for the development of temperature linkers, temperature linked bonds or options, etc. That would offer a good way to hedge this risk, and there is an insurance gap in that field, so that could definitely be something interesting to fill this gap. It would also have a lot of informational benefits, conveying prices, expectations of financial market participants on these questions. So that's also an innovation that I think would be very useful, and where we could see maybe further developments.
Okay, thanks a lot, Marie. So I suggest that we only have 14 minutes left, so we open the room for questions. Barbara, Geoffrey, you mentioned the role of governments, regulators, either in, and Marie as well, on the coordinations of trajectories, the fact that potentially solutions could be blended solutions with public and the private sector. There is a first question in the chat on the fact that the current effort to green central banks, financial institutions, could also be a way to make climate policy more credible and therefore make investors believe in and create the green path. So we'd like to have your comments on that. Barbara, maybe you want to start?
Sure. No, and I did, just before I go to that, react to what Geoff said before. I think on this blended finance, I think it's so important, and you know, I a bit what mentioned the risk, the word risk here, but a lot of what we do. Our innovation bucket is actually coming up with innovative financial instruments or business models that actually allocate the risks according to who is best willing and able to take on this in the private sector. And I think this is where it is so important to use actively and really use it to de-risk and really kind of see new instruments that can really bring some of the investments into, you know, developing countries, emerging economies. I just wanted to mention that because I really want to echo. If people are interested, I'd be happy to share in the Q&A maybe a link of an incubated overseas where we have been, with the help of a private partnership between, like, you know, development finance institutions, treasuries, and, you know, commercial banks, institutional investors, foundations. We've managed to actually incubate almost 50 instruments and business models that have collectively mobilized $5 billion for concrete projects in emerging economies, and most of them, while at the beginning have this pathway towards commercial viability. And so I think it's about money at the beginning to really, again, and that comes, I think, a little bit to the question, Sophie. It's so important to use this to really make also private investors feel comfortable, but also private investors. I think it's so important to really build the capacity there and really ensure that investors understand with this kind of backing from public capital, but also through public policies, you know, how they can really scale investments and actually go into this area. So I've been talking too long. Over to Geoff and Marie.
Geoff?
Well, I certainly agree that central banks can be important here. And central banks have a huge amount of credibility and a huge amount of influence, so directly and perhaps as much as anything indirectly. So I think for central banks to take a position on climate change, to indicate they think it's important, and to emphasize the importance of monitoring and disclosing and managing climate-related risks is absolutely central. Yes, I think it's key. And incidentally, I like the idea that Marie mentioned in this context, which is the idea of climate-related bonds. Now she mentions it, I'm surprised we haven't got them already. It's such an obvious idea, but it's a very good one. I mean, we have weather-related securities in the US, so you can buy securities which will pay off if and only if the temperature in New York exceeds 95 degrees or 100 degrees or something on a particular day. But those are sort of short-term weather. They're not climate-related bonds. And I think that climate-related bonds would be a good way of hedging certain types of risks. So that's maybe something that central banks actually could encourage.
Thank you.
Yes, and it could bring credibility. If governments issue these climate-related bonds, they would have skin in the game, right? So they would be incentivized to follow the path. So I think that's a good way to incentivize them.
So Stefano, there is a question in the chat that is made for you. Given that both the EU and the US are putting a huge amount of recovery money into green deals and the like, could this be a big enough policy shock to change investors' expectations? And I'm going to complete a bit the question. You didn't have the time to talk about other alternative solutions on fiscal policies. So can you say also a few words about that?
Yeah, thank you. So first of all, I'd like to pick up on what Geoffrey said before. I very much agree on the fact that as much as a carbon price is needed, we probably need a very likely a much more comprehensive policy framework and multiple things at the same time. And because the political economy of the carbon tax is complex, we've seen that in France, we've seen recently in Switzerland, where the referendum has rejected the CO2 law. How can you bring credibility to that? Now, certainly central banks, and I agree again with Geoffrey, they have a very strong credibility. At the same time, we shouldn't expect central banks to do the job of essentially making economic policies. So climate change requires essentially economic policies, and financial policies can simply be instrumental to that. And so, in particular, about the discussion about the green monetary policies and so on, I think that the cleanest way to think about this is just make sure that the financial supervisors are recognizing the risk that is deriving from both physical and transition risk in climate, and make sure that that the market players are recognizing and assessing that risk, and then things will percolate throughout the economy and to the level of investments. However, and that's where the catch is, risk is endogenous. So unless there is a very clear path towards in a direction rather than another one, it has to be a very different one from the baseline, because currently we're still heading above 3 degrees by the end of the century, which still means that we are going to have, by the way, same level of emissions that we have today, at least, which then would take another 50 years to, if ever, decarbonize. So it's not just the 3 degrees at the end of the century, but it's also the fact that we would be missing entirely the mitigation objective, which requires a decarbonization. So this means that coming back now to the recovery funds, well, we have seen that actually not only just in the EU and US, but also around the world, many of these packages are not that aligned with climate targets. And this, in fact, has been a kind of a missed opportunities. And they could be could act as a very strong signal, but we haven't really seen that. And I'm sure that Climate Policy Initiative will monitor that more in the future. But this is, I think, where we need a lot more development. And so to conclude, we have to hear the policy problem that we have here is to find the right balance between the economic policy, which in turn are both fiscal and well, to some extent also financial, and then the monetary policy. So everything has to come a bit together with the common idea that there is a long path, which is different from the current one. And if that is, once this is internalized, then the risk level will be adjusted. And currently that's, so, and final point, also related to what Marie was saying, yes, we see a big increase of ESG investments, but if you look at the risk premium on low carbon versus high carbon, they're essentially the same, or a few basis points, if ever. So that is completely inconsistent with the capital reallocation that is needed. I don't know what Barbara thinks about this, but that is my take on that.
Sorry, I have to interrupt you a bit. There is an interesting question in the chat on the fact that the green transformation is partly at the expense of the other environmental sectors, in particular water, for instance. These damages are currently not priced. What does it imply for green finance?
Yeah, kind of a quick reaction on that. So, for instance, the taxonomy, the European taxonomy, and I know there is a number of criticisms that have been arising, but let's also acknowledge the fact that it is a systematic effort where it started with the climate dimension, and within the climate dimension, the do no significant harm criteria implies that the activity has to contribute to mitigation and at the same time not breach on other critical objectives. And among these, there is biodiversity, water, and others. And of course, it's ongoing work. But basically, the idea is that you need to classify all of the economic activities and try to make sure that they are aligned with the multiple environmental objectives that we have. And climate is the moment the most mediatic one, but biodiversity is the next in the line in terms of urgency, for sure.
Yes, I would agree with the idea that the pricing is endogenous. It depends on how much investors care about that. On water, there is a huge development as well. I mean, of course, it's not at the size of green finance, but there are new water funds that are created, etc. So when the industry will go into that direction, I mean, the pricing will be incorporated as well, right?
So I have two questions. The first one is, what do speakers think about putting an incentive on banks to apply green creditors through capital reserve requirements, for instance? Could that be a solution? And a question dedicated to Geoff. Is there a win-win strategy of integrating global financial markets conditional on minimum regulation in host countries? In turn, creditors find invest opportunities.
I have a quick reaction on the green. This will be essentially a green supporting factor. Of course, banks are lobbying for that a lot, and they have been lobbying a lot in the last year. One argument against that is essentially then increasing the level of risk and potentially also systemic risk, while not necessarily guaranteeing that there is indeed an increased level of investments where it's needed. As I said before, from an economics perspective, I think the cleanest solution is making sure that the risks are recognized and acknowledged and computed, the levels of risk, and they are, of course, conditional to the technology of the various firms. And once this is done, then the level of investments should adjust. However, the problem is, and that's where there's no other way of having policy intervention, that the level of risk has to be recognized consistently with the climate targets. That's where you have to break the circle.
Okay, so time flies. We only have 1 minute left, so I'm going to ask each of you to take a couple of seconds to conclude or mention something important you didn't have the time to say. So, Geoff, do you want to start?
Sure. I was just looking at Klaus Eisenach's question about housing. I think that's actually a very important issue. And there are three big sources of greenhouse gas emissions. One is energy production, obviously, and we talked about the energy transition. The second is transportation. And the third actually is buildings. Here in the US, there's 28% from energy production, 28% from transportation, and 26%, I think it is, from buildings. So controlling greenhouse gas emissions from buildings is actually crucial. We haven't talked about that. It's very difficult, actually, because of the long life of buildings. A typical building lasts 50 to 100 years, whereas a car lasts much less than that. So it's very few policies have been implemented anyway to try to reduce emissions from buildings. So I think it's, I haven't got time to say obviously, but I think it's really good that Klaus put that on the agenda, at least.
Thank you. Barbara, do you want to say a few words?
I think what I just want to maybe leave here is, I think for me, there's been a lot of really positive developments in the sector, and I think I really enjoyed the panel here and listening to what others think. And I think what you've seen, particularly in the last year, is this evolution and this really flurry of new net zero announcements to sector, which is great, but I think this really requires that we pay much more attention to the integrity and the accountability of this targets, because I think we have, and I think that comes we can understand how the different coalitions and the announcement actually compare. Are they really allowing us to be on the right pathway? Are they in line with the scenarios that get us on the right temperature pathway? So just like my point here is, like, I think we got to start working, not much in silos anymore, but really working together and trying to understand how can we really make sure that we shift the entire financial system. Easy job, but I believe in us.
Thanks a lot. So, Marie?
Yes, one point would be that investors' preferences are key because it influences the pricing of carbon risk, climate risk. It modifies also, as Stefano has shown, the transition trajectory. So it's very important to understand that. And one point I wanted to make is that the European Commission efforts in that direction, because they are working on that and asking probably next year to impose that, to ask about sustainable preferences of clients in Europe, will be very important, I think.
Thank you, Marie. Stefano?
Yeah, maybe one final point is that what we've seen in the last years was a sort of a gridlock where policymakers would argue that we have to wait for the market to integrate the information and then move. And then the counter argument is that, well, but even if they do, again, the risk is endogenous. And on the other hand is markets, in fact, when you're asking market participants, and maybe confirm that, investors are saying, well, we're waiting for the signals. And so there's been this wait game that has been essentially delaying action for a number of years now. And it's time to break this. And hopefully, I think also, and that's where also economic modeling can contribute by recognizing essentially this indigeneity and the role of it's just as a repetition of what I said before, but is the credibility of the policy, which implies that policy has to take the responsibility of shifting from one path to another one. There's no other way.
So thanks a lot, Stefano. Thanks very much to the panelists for these interesting discussions and thoughts. I would like also to thank the audience for attending the panel discussion and have a nice afternoon. Bye, everyone.
Thank you very much. Bye-bye.
Thank you. Bye.